Okay, guys, let's get going. Thank you for attending this webinar this morning with Tide and Leyton and partners. My name is Kuan Hawker. I'm the event manager here at Tide. It's great to have these webinars up and running now. We're having some great discussions on a number of subjects. Just to give you a bit of background of Tide and what we do, I know there are probably a lot of our members in this webinar, but for those of you who don't know what we do or don't have a business account with us, just a bit of background. So we are a business current account provider designed specifically for SMEs and freelancers to save them time and money with their banking needs. Currently we have about 160,000 customers in the UK, and we're the fastest growing current account for businesses in the UK, which is no mean feat, let me tell you. Great for startup and small businesses, no monthly fees, no minimum deposits or credit checks, so you can try us totally risk-free, which is great. It usually takes about 5 or 10 minutes to set up an account with us. You get your sort code and account number immediately, and quite embarrassingly, I've been with Tide for about 8 or 9 months now, and I only just signed up for my account yesterday as a bit of a test, and I timed it, and it only took 3 minutes and 47 seconds, which was quite impressive. And I should be getting my card tomorrow, so quite embarrassing, but a good test just to prove that it's quick. The app itself really packed full of features to help you out as well. You can have auto categorization of your spending, so you can see exactly where your money is going. You can do all your invoicing through the app, which is you can be paid and generated through the app and links in with the accounting software you're using too. And you can also have the account split up into 4 sub-accounts. So you can have one for your taxes, for your marketing spend, for any event spend you have, all that kind of stuff. So really useful tool if you're an SME or a small business owner. So saying that, I am really pleased to have got Leyton and their partners for this webinar this morning, aiding business continuity during COVID. I will be back later just to give you some information about a special offer that Tide are currently running for new members. But for now, I'm really happy to hand over to Mark and his team to give you this interesting and exciting webinar. So thanks, Mark. Take it away.
Thanks very much. Cheers, Kieran. Good morning, all. Thanks very much for joining us. Great to have you with us, and also thank you to Tide for helping to put today's webinar on. We really hope you're going to find it useful in taking away some kind of practical tips and actions to help inform your business and some of the decisions you make as you move towards a recovery. So firstly, a bit of housekeeping. We are recording today's session, and then towards the end of the webinar, we'll have a Q&A. So feel free to type them into the chat function, and we'll look to cover off as many as possible. I know today's audience predominantly made up of SME business leaders, tech leaders, and HR professionals. So there were a couple of links to resources that I just wanted to flag that are known have been extremely useful and popular. Firstly, tip of the hat to Tide. I know they were very quick to launch their eligibility checker chatbot to identify relevant support, relevant funding. Also the .gov website for the coronavirus support finder, which I know has stood up to huge demand. And then finally, Innovate UK, who have seen demand go through the roof. Only last week they saw, they rewarded and approved 800 grants for businesses, SMEs, and around 40 million delivered to those businesses. So a bit about Leyton. Leyton now operates in 11 countries across 27 offices, founded in France 22 years ago, and opened our UK business in 2010. We employ scientists, engineers, developers, and tax professionals, and have been partnering with our over 5,000 clients since then to champion British innovation and really give them access to innovation funding, whether that be the range of creative sector tax reliefs, patent box relief, R&D, or indeed capital advisory services. And then also through LexLeyton, our regulated law firm, we've got a team, and one of them's here today, Musa, thanks for joining us, commercially minded lawyers who collaborate with those SMEs, either on a retained or a project basis, to really help them build and maintain a sustainable business. So over the last 10 weeks, the world has changed in so many ways. The relative certainty of markets, supply chains and employment has disappeared. And entire industries are under tremendous pressure to survive and try and navigate towards recovery. But with this uncertainty does come opportunity. And in talking to our clients, we are seeing companies and leaders embrace those challenges and opportunities of what the new normal may bring. And actually, through necessity, many of these companies are innovating at an even faster pace than ever before. So whether that be biotechs delivering vaccines and testing, whether that's UK tech companies embedding automation and AI within local and central government departments to help cope with the increase in demand, or drones being used to fly PPE to remote Scottish islands, or construction companies accelerating the transition to off-site build. And actually, April was the busiest month on record for patent inquiries. So innovation across many sectors in the UK is alive and kicking. And in today's webinar, we're not going to offer a magic wand, eliminate risk, or paint a picture of a quick economic recovery. But we will, however, try to illustrate that even in these turbulent times, there are practical and accessible ways to maximize and generate cash flow and to prepare your teams and business for the recovery and new ways of working. So without further ado, I'm going to introduce our panel. Firstly, we have Radeep Matthew. Radeep leads Leyton's innovation funding team, and in the UK last year worked with over 5,000 clients. He also sits on HMRC's consultative committee for research and development. We then have Paul Shepherd, CEO and founder of We Build Bots, winner of many prizes, both himself and the company for innovations in tech. And Paul's been running digital and data-led businesses for around 10 years now, so be able to bring some great insights there. And then last but not least, Musab, who's got to be one of the hardest working employment lawyers in the country right now. If you've had the good fortune of hearing any of the webinars he's been on or the podcasts over the last few months, you'll know his knowledge is second to none, and there's a real skill in translating those often kind of complex government updates into practical advice and then tailoring it to the specific needs of the business. Over the last 9-10 weeks, we've seen a huge number of funding support packages rolled out to the UK, many of which have seen a huge take-up. Others have been refined, improved and changed based on feedback. But they have enabled many businesses to access the lifeline needed to continue trading, and many others to plan accordingly and navigate themselves through the next 6 to 12 months. Those measures are extremely welcome, but they do have some implications for further down the line, whether that be in terms of repayments, interest, or potentially business ownership. And given the widespread popularity and knowledge of these options, we're not going to be going into them individually today. Instead, we're going to focus on a government funding scheme that actually celebrates its 20-year anniversary this year. It's supported UK business innovation, seen some significant growth to the tune of £27 billion. So we're going to focus on the R&D tax scheme. Some of you will know about it, some of you will have heard of it, and perhaps thought maybe it doesn't apply to my business. But it was first introduced in 2000 to assist the UK in attracting both foreign R&D direct investment, as well as encouraging existing domestic R&D activity. Off the back of that, 2 years later, the large company scheme was introduced. And then since that, there have been significant changes, improvements that have been implemented by government to benefit those companies. Now, the percentage of R&D that takes place in this country sits below our European partners and global partners. But the key aim is to incentivize innovation, ensure the UK remains competitive and continues to generate and help the right skills to be nurtured. And progress has been made. Over the last 5 years, the scheme and the number of SME claims sat at just over 5,000. And the last available figures for 2017, 2018 shows that that number has grown to 45,000. So I'm just going to move through to the next slide. Kieran, if you could just enable that. There we go. Hopefully you can see that. So as I mentioned, when we compare ourselves to other countries, we are lower, currently spending 1.6% of GDP on R&D, compared with an average of 2.4%. The government has recently announced in the April budget that they are looking to increase public spending and meet that average of 2.4% by 2025. Other countries have shown it's been possible, and we have seen places like Korea, Austria over the last decade really thrive. As you can see from this slide, there is a regional bias. London, the southeast, and also east of England take up a significant proportion of claims. And I know there's conversations going on with government to talk around how they are potentially going to give that money directly to regions, directly to councils to distribute themselves. So I'm going to pass on to Radeep to go through the details around the scheme, the practicalities of it. But I guess I just wanted to leave you with a couple of key trends that we've seen over the last couple of months. Firstly, as companies move through and meticulously work through their cash flow forecasts, they've approached us to sense check their existing R&D process, ensure that they're claiming on all the projects and expenditure that's eligible, and in a significant number of cases, those qualifying costs are going unclaimed, and Radeep will come on to this. But secondly, what we've also seen is both accountants and businesses have a bit more time to look into eligibility. So sectors as diverse as farming, renewables, bakeries, and fire and security have started to look at this. And no, not all have qualified, but at least we've been able to ensure that they're not missing out and to educate them on the types of projects that do qualify. So Radeep, I'll hand over to you to talk through the scheme in a bit more detail.
Cool. Thanks, Mark. Guys, yeah, what I'll do is I'll probably spend 10 minutes or so getting into the R&D mechanics and the eligibility criteria. Probably people are aware of the scheme. There's plenty of material and documentation available from HMRC, but I'll try and keep it very high level for today's purposes and for in terms of the time. And the way I'll do it is I'll try and answer a few questions that will take a person through the claim process journey and what do we need to do, etc. So I guess the first question is, who can claim? I guess that's the first question. So what the guidelines say is any company in the UK, so any company registered in the UK and that is subject to corporation tax in the country can make a claim. So this could be a standalone entity, maybe a startup or a company standalone, or it could be a UK entity that is part of a wider global group. So it doesn't limit you from claiming irrespective of that. Also, there are certain scenarios where permanent establishments and UK branches of wider group companies could also. But I think the key condition is you should be subject to corporation tax in the UK. There are two schemes primarily with respect to R&D. One is the large company scheme, and the second one is the SME. To understand which scheme you fall under, there's basically a 3-point criteria. You check whether the employee headcount, turnover, and net assets kind of a measure. So if a company is more than 500 employees, then they fall directly into the large company scheme. However, if they're less than 500 and the turnover is less than 100 million euros, or balance sheet 86 million, then you could be an SME. Why this is quite important is the SME scheme is circa 3 times more generous than the large company. So SMEs are trying to be given a lot more of the credits to help keep afloat, keep innovating. And as Mark mentioned, the whole concept is for the UK to be the market leaders in innovation and R&D in the kind of global environment. For an SME, I'll keep a lot of my discussions more to an SME because I think the audience would be more from the SME community. For SMEs, in summary, a company who could be eligible for R&D could get back anything from 19 to 33% of their spend on R&D. Now, why is there a difference? I'll come to it later, but it's linked to the company's tax position. But in summary, you can get up to 33 pounds for every 100 pounds you spend on R&D, which is a very lucrative and a powerful way of funding your innovation for the future. The next question is, I guess, what is R&D? What's the definition of R&D? So I can claim. Now, what do I need to look for? Again, a lot of HMRC guidelines, a lot of text. They've tried to make a good attempt at explaining the concept, but I would say anyone who's seen it would kind of summarize it. Okay, it's quite abstract and quite restrictive in its explanation. Now, people tend to have a very rigid perception of what R&D is. I mean, in these unprecedented times, I know there's so many work streams happening in the world trying to find the next vaccine to take care of corona, the COVID-related problems. For sure, that is cutting edge R&D and probably the top end. But the R&D scheme is devised in a manner where the definition is a lot broader. So companies are involved in product development and process improvements in different forms and shapes could be eligible. So it's a lot broader is the kind of summary that I would like to bring to the table here. Having said that, you are looking to kind of satisfy 3 main criteria to be eligible. And the first one is, as you can see on the bottom of the slide, the scientific or a technological advancement. And here, what the concept is, if you have any new product development or improvements that you're carrying out, as long as you kind of trying to build new knowledge beyond what is readily available, and as long as that is linked to a field of science and technology, you could meet that criteria 1. And this can be in the form in software, engineering, science, all the verticals. It can be in different forms and shapes. The second condition linked to that is the overcoming the uncertainty, as it says. So here, surely companies undertake various projects, and if it's not routine, you're bound to face roadblocks. You're trying to do an interesting project, and as your experts work on it, you're going to encounter challenges. And as long as these challenges are not straightforward to resolve, and you guys, the team needs to brainstorm and come up with different ways of overcoming those roadblocks, and that was not straightforward, you meet condition number 2 as well. And the third one is quite an easy one. I think any project in this current day and age, be it agile or be it in a very regimented, structured process in different sectors, you would tend to go through a very iterative journey of trying to build that new knowledge and solve your problems. So condition 3 is very easy. I think what's really key is the first 2. Are you kind of trying to solve some problems where you don't have any ready-made answers? And as part of the journey, there is a systematic way of trying to trial different approaches. And at the end of it, even if you fail, you could still be eligible. I think that's really key. It's not the outcome that defines whether the project is eligible or not. It's the journey undertaken. So a failed project for technical reasons actually is a really good example for R&D. I mean, I'm sure the coronavirus example, there are so many, 70 or 80 in the world projects happening. Not everyone's going to succeed, but that doesn't stop you from, if they're doing it in the UK, doesn't stop them from claiming. So that's the definition of what to look for in terms of the R&D. The next question is, okay, I can identify R&D projects now. How do I link it to a number? In the end, it's a number that we need to identify on how much money was spent. And that's when the next question comes in. What are the kind of cost categories a company can include? And there are primarily 4. I'll go through one by one. First one is the obvious, I'm sure, staff time, in terms of labor. All your internal people, be it your engineers or your developers or your scientists, all the core technical members of your team involved in the projects, as long as there's R&D, you can attribute a percentage of their time involved on the R&D projects. There could also be elements of ancillary support staff, people within, not directly involved in the R&D, but supporting the technical members to deliver the project. So there are 2 strands that you could consider from the staffing side. But also the second category is third-party labor. Now this could be in the form of, if you could subcontract a body of your project to a third party because you don't have the full in-house expertise. And even if you farm out the body of work, as long as you're incurring cost, you could consider that. Or in some scenarios, what happens is you bring in contractors on a time and material basis to supplement your in-house staff to collaborate and undertake a project. In both scenarios, you could consider the cost you incur on those 2 elements. The third area is the category is consumables. Probably less to do with software sector, but more in the scientific and engineering sectors, where if you have to purchase, let's say, in a chemical factory undertaking R&D, they probably have to buy chemicals to undertake certain experiments. And as long as you are kind of using it for the R&D project, the only condition to be careful about is anything you purchase for the project, in the end, it has to be wasted. So if you add on and sell this to your customers, then you can't. But if you're it's transformed and wasted, then that is eligible as well. The fourth area is software licenses. This again, I guess, could be any sector, but any software license a company purchases to undertake the R&D, you could consider that as well. So in summary, 4 categories: internal labor, third-party cost, tangible consumable items, and software licenses. The next question, I guess, is, okay, I found the R&D projects, I've prepared a claim on how much money I've spent on the R&D. How do I make a claim? So here, how it works is we prepare those numbers and you make a claim in conjunction with the company's year end. So you make a claim every year, or in terms of linked to the company's tax return. So for the finance colleagues here, every company after the year end is finished, they have a year to file their tax return to the HMRC. And within that tax return is all the tax matters that a company needs to kind of report to the revenue on. And the R&D scheme are a few boxes or few numbers that gets plugged into that wider document. And that's the way you kind of submit. And how do you realize the benefit or receive the benefit? It's in the form of a tax deduction. So it links to my earlier point, SMEs, you can get up to from 19 to 33. Why I say that is, depending on your profit or loss position in the relevant period, you could be getting different levels of R&D. benefits. So, for example, if a company is profit making, the way it's going to work is you're going to reduce your tax liability. So you'll pay less tax as a result of including the R&D claim. If you're loss making, which is really interesting, is where we help so many different companies in the country. There are so many companies who are really innovative, putting in a lot of R&D investment, but they're still in the early stage of their career in terms of the life cycle. So they're probably not selling much, they're still investing. They probably are 3-4 years down the line is when they're going to realize and start turning over profit. But what the government's doing here is, if you're loss making such scenarios, you're doing something clever, I'll tell you what, why don't identify what your losses are related to R&D, and we'll swap your losses for cash. So this is a really powerful medium where you swap your losses, get a cash injection, and this helps you to drive or reinvest into the R&D and take it to the next level. And this is where I think we, out of the 5,000 clients we have a big portfolio of clients in this bracket, SMEs, startups who are kind of at the bleeding edge and kind of interesting R&D activities being undertaken, and who really look forward to the scheme being utilized to help them innovate and continue to reinvest. To kind of top it up and summarize my section, what are the kind of key areas to consider when, if at all, you're claiming or you're looking to claim? I think one really important thing is it's a really powerful cash flow forecasting tool. So like I said earlier, you could be, once you catch up to making claims, you could be literally looking at using the cash flow that arises from the R&D and using it in different ways to re-innovate or invest in different ways to take the company forward. The kind of second point I wanted to highlight is you can always go back 2 years. So let's say a company's got a December year end, you're December 19 that's just finished. You can go back 2 years. So currently, if you're a December year end, you can go back to your claim for the financial year ends 18 and 19. So you can look back and get some refund or credits in the form. The other interesting bit is in the current times, I know there are so many businesses looking for different options of loans, whether be it CBILS or future funds, etc., etc. There's plenty. I know there's been so much press and talk about the implementation, the delays, the credit checks, etc. And the R&D scheme is a more established and probably a less cumbersome one to pursue. The HMRC has been really good in supporting businesses through the scheme. Currently, if you're a loss-making or if there's a cash credit scenario, they are turning around claims within 28 days. That's probably quicker than any other cash flow opportunities you have in the market. So it's a really powerful tool at this time. Kudos to HMRC, actually, they've done really well to kind of help businesses in this forum. And how long does it take to prepare a claim? It varies depending on engagement, but you can turn around anything from 4 to 8 weeks from start to finish is where you can prepare a claim. And then within a month after, you're looking probably for receiving the benefit. So in 3 months or even quicker, I mean, we tend to sometimes do a week turnarounds, but generally it's a 1 to 2 month process. And in 3 months, you get the cash flow in. So it's a really powerful mechanism there. Last bit is for companies who are claiming. I had 3 or 4 bullet points on what to keep in mind. What I've seen from the industry and a lot of the clients that I meet, I tend to find that at times a lot of companies miss out on projects that are not internally driven. So it must have led to a project initiated by a customer request, and people tend to miss that bucket. So that's one area. The other area is the understanding between the subcontractors and the day rate contractors and how that has an impact. And like Mark always said, it's always good to get a second opinion because when you've been doing it with one provider by yourself, the rules tend to change and there's a lot of pockets of R&D that people miss out. So it's always, I would say, as a recommendation, to always revisit and review the process from time to time to make sure you're fully optimizing. Cool. I'll stop there with the mechanics and I'll hand it over to Mark, and I'm happy to field any questions later on once we finish through the panelist. Yeah, Mark, thank you.
Great, thanks very much for that, Radit. That's really useful. I know there's a lot of information there, so yeah, happy to kind of answer any specific questions as we move towards the back end of the webinar. Now, I'd really like to introduce Paul. In terms of Paul's CEO and founder of We Build Bots. And before you talk to us about your experience of the R&D scheme, Paul, could you tell us a bit about the company and really what you've been doing over the last couple of months? Because I know central and local government are your clients. So it'd be great to get some insight into that.
Yeah, sure. Thanks, Mark. Thanks, guys. So as Mark said, my name is Paul Shepherd. I'm the founder and CEO of a company called We Build Bots. Our core proposition really is helping local government to deliver better, faster, cheaper citizen services. And we do that through leveraging AI, chatbots, data analytics. And the example I always use in central government that seems to resonate is, instead of picking up the phone and saying that your bin hasn't been collected and being put on hold and God knowing when you may or may not get a response, you can execute that process through a chatbot that will either sit on the website, or you can do it through your Alexa or Google Assistant at home, and you'll get the answer you want. The service is a lot better, and it actually saves the council in question a hell of a lot of money too, because telephone agents and people answering emails are, through no fault of their own, slow, but also quite expensive from a company point of view. So that's our core proposition. It's really kind of come into focus recently with the outbreak, whereby local governments are under deluge really with more and more requests for information, whether that be personal information around health, information around education, information around tax breaks, rate cuts, etc., etc. There's brewed a perfect storm whereby workforces are cut either through the illness or the need to work from home, and yet the number of inquiries coming through to local government has spiked. So we've been able to implement our product quite rapidly across about 5% of the UK market within local government, really helping to stave off many of those inquiries by offering automated answers to commonly asked questions. So that's the work that we've been doing most recently. Should I say what I did before that, Mark, or should I stop there and let you jump?
No, go for it. That's really useful. Yeah, carry on, please.
Okay, sure. So I guess before We Build Bots, I ran a digital agency, which on the face of it might not feel that it's necessarily prime candidate for R&D tax credits, but we were approached, I don't think it was by Leyton initially, this was about 4 or 5 years ago. And having run the agency, I'd always kind of dabbled with product development, and I'd always seconded some of our developers over to a number of products, none of which really saw the light of day. There was a gaming product, but we never actually secured our gaming license, so couldn't launch. There was a movie analytics product, which took tweets, analysed the sentiment of those tweets, and then helped to predict box office take-ins. We kind of never really got that to market. But the point being, my eyes were open to the fact that actually I could soften the blow of some of these kind of failures by reclaiming a proportion of the money that we'd spent on trying to get them out there. So that was great. We took a look at that, and it does sharpen your appetite for risk a little bit. The analogy I use, it's similar to kind of EIS and SEIS from a private investor perspective, whereby you just know that you're going to reclaim something. If all goes wrong, then all's not lost. WeBuildBots was actually one of the product ideas that did make it out to the traps from the digital agency, and to the extent that we decided to spin it out as a completely separate company. That's when we first engaged Leyton. I think one of the Leyton guys reached out to us. We were impressed by the amount that seemingly we could claim, the proactivity of Leyton, and also how well the process seemed to be nailed down with Leyton, and how little kind of time it was actually going to take me and my team to get a claim away. So we did that. It was a successful claim, and we've done it. It's either 2 or 3 times since. We might be on our 3rd one for this year. And it's really useful for a number of reasons. We kind of bake it in now. We're still not profit making, so it drops in as a chunk of cash. We actually factor that cash into our forecasts. Last year was really interesting. We actually lent against, or borrowed against the claim, because a marketing opportunity came up that we really wanted to take, but we didn't have the cash to do so. So we were able to borrow against the claim, get a proportion of the cash earlier than the claim would have allowed, and we leveraged that market opportunity to win 3 new clients. So it was a really good example of how that kind of cash reclaim has actually helped us tangibly grow our business. And then the other thing is we understand now that when we go out to hire subcontractors, because we need an extra few pairs of hands to help us on a specific part of the project, then again we go into that knowing that almost like a VAT expenditure, knowing that we're going to get it back. And that really helps, whether it means that we go for a slightly higher quality person, or whether it means that we can hire a couple of people, again, knowing that we're more than likely going to reclaim a portion of that money back. So it's really helped us on a number of levels, from growing the business to really mitigating some of the risk that we feel we're taking when we go out and hire subcontractors for the various parts of the projects that we run.
That's brilliant. Thanks very much, Paul. That's really interesting. And we mentioned a couple of the other government schemes. Have you, as a company, have you taken advantage of any of those, and how do they sit in the mix with R&D?
We have, yeah. So we furloughed just 2 employees, and we made the decision to furlough them because they're probably the least busy of the team at the moment. And as it happens, that by definition for us, that means that they're probably the people against whom we're least likely to claim any R&D rebates. Okay. And we've also secured the business continuity loan as well for WeBuildBots. And for us, everything we do is all about still extending runway. We're still, even though we're in market and we're revenue generating, we're still putting a lot into R&D, things like natural language understanding, big data analytics. So everything we do is with one eye on trying to make sure that the runway is slowly moving away from us as opposed to towards us. So again, when we factor in that runway, part of that equation is what we think we're going to get at the end of the year through our R&D reclaim.
Great. Thanks very much, Paul. Really interesting to find out how it fits into the mix. I'm going to pass on now to Musab, who I know has been dealing with businesses across many different industries, and specifically around the points that Paul just touched on. I think it's up to 2/3 or 3/4 of UK businesses have furloughed staff. And Musab's just going to give us, pull out some key aspects that businesses and business owners need to consider when moving towards recovery. So thanks very much, Paul. Over to you, Musab.
Thanks, Mark, and hello everyone. Thank you very much for sticking with us up until me. Unfortunately, it's not going to get any better for you having to listen to my dulcet Scottish tones. We've been, as Mark said, supporting businesses basically across all sectors where the impact of COVID-19 has been felt. The options available to employers to respond to the threat really varies greatly from industry to industry, and Paul's mentioned some really interesting ones there about using the interruption loan scheme, about accessing the coronavirus job retention scheme, for example, and factoring into his business planning R&D relief as well. For professional services firms like us, we've been able to largely switch en masse to home working, but many other companies have been unable to do so, and they tend to opt for a combination of furlough and some form of revised business as usual, if we can call it that. I mean, we're definitely not in Kansas anymore as far as working practices are concerned. At the same time, restricted cash flow and the closed pathway to revenue for a lot of these businesses has meant that a lot of them have had to take some quite difficult decisions. And as we are now looking towards the back end of lockdown and the scaling back of some of that financial support which the government introduced over the past 3 months, such as the extended coronavirus job retention scheme, a lot of business leaders who we've been speaking with are preparing themselves now for staff to return to work and what that will look like for them. When businesses were initially preparing for lockdown, they were carrying out an initial assessment of the needs of their business and the restrictions as they related to the particular threats that were posed by the measures. So in doing this, a lot of employers tried to formulate a plan. And that went so far as to try and protect their business in terms of its long-term efficacy. And many also had a very big eye on how they would look after their people that were working for them as well. For some, there was still the requirement to trade, keep the operational clock ticking. And what we've identified in the businesses that we've been speaking to over the past several months has been a fairly methodical process where businesses record their objective rationale or their business case and keep that under consistent review. It meant that every time there was an announcement by the Chancellor or the Prime Minister or one of the First Ministers of the respective devolved nations, every time HMRC published new guidance or their directive in relation to the coronavirus job retention scheme, or any time new measures or support packages were introduced, businesses had the ability to flex and be dynamic and respond to those. The same rationale and that same flexibility should be applied as well in relation to returning to work. It's certainly prudent for decision makers to consider which roles will be required and when. It's very unlikely that supply and demand are going to return to normal for quite some time for a vast majority of sectors. So a lot of businesses are going to find that their existing cohort of staff might not need to return in full straight away. There'll probably be some functions that immediately are not required at all. Some departments may have to come back with a reduced level of staff, and others, where they need to return, they'll have to look at ways of varying the way they work, either by looking at changing their hours of work, changing their systems of work, or the tasks that people carried out as well. The government's extension of that furlough scheme means that employers do have an element of flexibility. They can keep some staff home until October potentially, and they can look at how they can support staff working part-time in order to reduce their overheads, particularly wage costs. However, we know now, and we anticipate it will be clarified in the coming month, that from the end of July, the coronavirus job retention scheme will evolve, requiring employers to contribute towards running costs. So for many businesses, the time really is now to start to enact some of the plans they've put into place, rather than waiting for the change to happen and not having the necessary cash flow or revenue in reserve to sustain their business through that next period. One of the big challenges for many employers are concerns about the ability to return to work safely. And the decision or the decisions that have to be made by employers on this are inevitably going to have some contention among their workforce. My recommendation is that employers should be mindful of the risks associated with taking disciplinary action against anyone who cites health and safety reasons as a refusal for refusing to return to work. There's an issue there that employers can resolve by perhaps asking for volunteers first and taking the necessary steps by accessing advice and using the government guidance from the Health and Safety Executive or from Public Health England. We all know by now that there's going to have to be some robust risk assessments put in place. Businesses may have to consider whether they are able to make available PPE, provide that to their staff, and changing common working practices. A lot of these steps, if they're well communicated to your team, will invariably reassure some of your worried workers. But where they don't, you're going to have to still make some decisions about how to deal with those who refuse to come back to work. Keeping them on furlough is one option, but as we now know, from the end of July onwards, that will be less attractive to businesses because of the cost implications. Where an employee has been furloughed or has been working from home, a return to work after several months of being at home may come as a bit of a shock to the system. So try and be mindful as well of the impact on mental well-being for your staff. As is the case when an employee comes back to work after a long-term period of illness, it's important to have conversations in advance of any return to work with the affected staff and try and discuss and reassure them if they have any concerns. The best way, in my view, to approach these conversations is to be as authentic as possible. Try and understand what the practical challenges of the staff are explaining to you. Things like commuting at the moment are more challenging. Childcare is the other big one, where many people are still feeling the effect of the government measures, and a large number of schools and nurseries remain closed. All of these add to the overall impact and the decisions that people will take around returning to work. Unfortunately, we've seen over the past few weeks that a number of employers have not approached this task well and have tried to enforce people coming back to work. I saw an article in The Guardian about a week ago in relation to, I think it was Dyson, and Dyson had enforced a return to work pretty much across the board on 1 week's notice, which then was met with essentially a mutiny by their staff and a complete change of tact by their CEO. That's really a situation that any business wants to avoid, that huge employee disharmony and not having any real operational benefit deriving from that decision. If your business has access to something like an employee assistance program, or you have trained mental health first aiders perhaps in your HR team, you can signpost employees to these resources. If you don't have one, there's a large number of free resources available to you, and these can be accessed by employees either online or via telephone. We are continuing to see some excellent cooperation and collaboration between different businesses and different sectors as to how they can aid each other in combating not just the industry impacts of COVID-19, but also the concerns that some employees are raising, particularly where you have staff that are required to travel to different sites or different places of work. Whilst I'm confident that approaching the return to work in an understanding manner will mean that employers have a proper opportunity to ensure that their employees remain engaged, safe and productive, it is key that employers are mindful that they may have to make some difficult decisions over the next month or two. Not everyone is going to accept the decisions that you make, but I think holistically, making sure that your business survives the next 3 or 4 months, is in a position to prepare for resurgence and starts to trade and have that clear pathway to revenue, will ultimately ensure that your business survives and you're able to retain as many jobs as possible. Even prior to lockdown, the government had introduced something called their Good Work Plan, which was part of the Taylor review into modern working practices. And that had insisted for some time that flexibility would be the new norm. Flexibility can mean quite a few things. It doesn't just mean flexible working requests, or changing working patterns or home working. You can do a whole number of different things to create flexibility in your workspace. The importance of that flexibility can't really be understated at the moment. Staff retention is going to be crucial for the coming 6 to 12 months, particularly if you have some really strong players in your team, people who are perhaps team leaders, who are able to deliver the output that you require, have good relationships with your clients and customers. Retaining those key people is perhaps more important now than ever. One thing you certainly don't want to be doing as a business is incurring the costs of recruitment and training of new staff because you've been unable to hold on to those key individuals. If you are looking to change the working relationship between you and any of your staff, that will require a degree of collaboration, a degree of consultation. You may look at more robust or broad performance metrics. You may look at different ways of assessing what employees are required to deliver. And that may become more prevalent on a longer term basis where cash flow is a bit tighter, particularly through this recovery period. Being able to manage that transition in contracts successfully during a lockdown particularly is quite challenging. And one of the things that we are doing over the next week is launching our new landing page, which will provide a host of free resources to businesses that they're able to access, giving them guidance on really a large number of things, ranging from how to return to work, dealing with employee objections and concerns, signposting on health and safety considerations for employers, alternatives to redundancy and how to approach them, and also how to approach contract variations. The last point that I really wanted to mention was around some of the government health and safety guidance, which emphasises a requirement for employers to consult with either employees or employee groups like trade unions or workplace councils around the risk assessments that are being undertaken before you facilitate any plan to return to work. How you communicate what measures that you're taking with staff can be done either in a collective way, or it can be done more individually, depending on how your business prefers to approach that task, and also the size and resources available to you. Having strong engagement with employees at the planning phase is more likely to reduce the number of concerns and issues that could prove a stumbling block when you do begin to migrate back into work. That's really all I wanted to say on that point. Again, like Radeep and I'm sure Paul, I'm more than happy to answer any questions from anyone. So thank you. Back to you, Mark.
Great. Thanks very much, Musab. A lot of information there. Thanks very much. So now we'll move on to Q&A. There's been a few questions come through, and I'll read out the first one. So I guess this one's for you, Musab. What type of business restructuring have you seen the most of? Anything positive? Looking to improve how the workplace operates as opposed to just cost cutting?
Yes, absolutely. One of the inspirations behind a guidance that I prepared on 10 alternatives to redundancy came from a conversation that I had with a fairly large UK-based logistics company. They had lost quite a bit of their work particularly to small retailers, but they had increases in their work elsewhere, so some NHS work, for example. And they were having to just essentially restructure their business where huge teams had no work available to them. And what they were able to do was to essentially redirect the skills of those employees to the areas where there was an increase in the demand for work. So it wasn't a significant challenge in terms of training for them, but what they identified was one work stream of their business had almost completely closed down, with very little prospect of a quick recovery, certainly not quick enough for the business to sustain all of those people in employment for a long time. But on the other side, the other big work stream of their business, they'd seen this huge upturn. And so rather than simply treating the problem separately, they looked at the holistic picture for the entire business, and they began to migrate people onto many different duties from what they traditionally had done. But what was quite uplifting for that business, and something that they reported back to me was really positive in their view, was just the receptiveness of the people. They were really amenable to these conversations about changing their job, about doing something different, because they recognised the challenge that the business was facing. They recognised the difficult situation that they would find themselves in if that part of the business was not able to survive. It meant that they had no job security. So for the business to be flexible, move those people into an area where they could continue to add value, not just for the business but for its customers, even if it meant doing whole different jobs to what they were doing before. That was an extremely positive outcome. And on that one, I think we saved around 300 to 400 jobs that would otherwise have been at risk of redundancy. So there are some incredibly uplifting solutions available to businesses who are prepared to be flexible in their approach and think more outside the box. I think particularly, just one more point on that, Mark, traditionally businesses have had a perception of how to approach challenges like redundancy exercises or contract variations, and they approach them from the perspective that people will be resistant to that idea. I don't want my contract to change. I don't want to be engaged in a redundancy process. My recommendation to anyone who's listening would be shed yourself of that assumption, because we've tumbled down the rabbit hole now. We're in Wonderland. Things have changed dramatically in the last few weeks. People will approach these conversations in a different way. People are more amenable to you. They understand what's going on. They understand the significant challenges that businesses are facing. And I think largely they appreciate that you are looking for a solution that benefits them, rather than just saying, okay, pull the trigger, 400 redundancies, now let's not worry about them anymore. So that approach, that shedding yourself of any assumptions you had about how people may respond to these conversations, is a good takeaway from that example.
That's great. Thanks, Musav. I think, yes, I guess the general perception is that people are resistant to change, but actually what we've seen over the last couple of months, whether that's businesses, whether that's people, is that actually people do like learning new skills, trying something new, being more open to alternatives. Good, thank you.
Mark, sorry to interrupt. Can I just jump in for 1 second?
Yes, go for it.
Doing it. Just wanted to say to everybody on the webinar, obviously we've got to 12 o'clock now. We will continue doing the questions as people are here. If I'm aware people need to jump off at 12, this is being recorded, and we will put this up on the Tide website later this week. And we will send an email around with a link to that. On that email as well, there'll also be some information of how you can open a Tide account, and if you're a new member, using the link that we send you on the email to the email address you've logged on during this webinar, we'll also give you the opportunity to get a free £50. So if you deposit £50 in your account, we will match that. That's just for a special offer for this webinar, but yeah, didn't want to cut the webinar off. We'll continue with the questions. I know there are a few more coming in, but just wanted to let people know that if they have to step off for another meeting, feel free to do so, but we will continue. I'll hand back to Mark. Thanks, Mark.
Great, thanks, Kieran. I think there are a couple more. I think we'll answer one more live and then come back individually to each of you. So this one is for Radeep. So will you be able to include money spent from a CBILS loan in a future R&D tax claim?
Yeah, the short answer is you can, but I think there are some finer facts you need to bear in mind. I think there's been a lot of messaging and confusion as well. So a CBILS loan is considered a state aid as per the European framework. So getting a CBILS loan or applying and getting a CBILS loan doesn't prevent a company from making an R&D claim. There's been a lot of confusion and messaging around that. However, if you get a CBILS loan and you're using that money for non-R&D related projects for other aspects of your business running, and you still have an R&D project to claim for as an SME, there's no subsidy or no problem. You can make it as usual. However, if you use CBILS loan money to fund parts of your R&D project, then those projects will have to be claimed under the less lucrative scheme. So you can claim, but there are some nuances to bear in mind under what scheme and what kind of a benefit you could receive. That's probably the short answer.
Great stuff. That's really useful. Good. Well, as I say, we've got a number of other questions. Won't push into people's lunch hour, but we will come back to you individually on those, set up a call and give you some information. So I'd like to end by firstly thanking Tide. Appreciate you helping us to put this on, and also to a fantastic panel. Musab, Paul and Radeep, really appreciate your time. Thanks very much. Stay safe and look forward to speaking to you again soon.